In this video, we're going to talk about how to swing trade in a trading range. The first thing we need to distinguish is swing trades from scalp trades. Scalps happen faster, but give you a smaller profit and can also be higher stress, while swing trades take longer, but give you a much bigger profit and are low stress. So if you like making bigger profits with less stress, you want to learn how to swing trade. The next thing you need to know is that the market can only ever be doing two things, trending or ranging. So that means it's either heading in a direction or it's staying within a range. We call that a trading range. Here's an example of a trend, and here's one of a trading range. Trend, range, trend, range, trend, range. When the market's trending, it makes sense to trade with the trend. That's because the market has broken out. It's now clearly moving in a particular direction. So going with it gives you a higher profit potential, and sometimes the only profit potential. When this happens, it's pretty clear. It's also pretty easy to identify, even for beginners. I mean, does this look like it's going up or down? If you said up, yeah, pretty obvious, right? How about this one, up or down? If you said down, yeah. And the thesis is that the momentum will continue in that same direction. And this has a higher probability because markets have inertia, which just means that they tend to do what they've been doing. So if it's trending, probably more trend. So when the market's trending, you want to trade with the trend. When the market is staying within a range, you want to trade against the trend or fade. And this is because the market is not just continuing to move further in a direction and instead is reversing often. So looking to enter as it reverses gives you the higher profit potential. And doing this has a higher probability because, again, markets have inertia, which again means they just tend to do what they've been doing. So if it's ranging, probably more ranging. Makes sense. However, this can be tricky because it will often be unclear exactly where the reversal is happening or when it's going to happen. So in this video, we're going to look at how to do this effectively. And for that, I use my setups. And my first two setups are for trends, but the third one here is for trading ranges. Second signal after a new high or low in a trading range. So with this, the pattern we're looking for is a second entry in the form of a reversal after a new swing high or low in a trading range, entering after a double top or double bottom forms on the close of a second signal. Now let's look at an example. First, we can tell that the market is in a trading range because we're getting big ups and big downs. And remember, we're looking for a second signal after a new high. So here was the prior high and this one above it. So now we have a new high and then we got a sell signal. So this will be the first signal. Then we went down and then we went up and made a new high here. And then this happened, making a second signal. First sell signal, second sell signal. Now we also have a double top here and here, which means we've met all our criteria. So okay to enter, and we will enter on the close and use our first option for our stop loss, which is above the new high here. And for our profit target, we have three options. If uncertain, just scalp for R1, keep it simple. Or if the momentum looks strong, for example, bars are getting bigger and they're closing with little to no tails, we can go for a measured move or recent magnet, something like a recent high or low. Now let's do a few more examples. Tuesday, April 18th, 2023. Here, after a couple legs down, clearly we have a trading range. The market's going sideways. Now, this was a leg down, and as you can see, the trading range is around here, but where's the high of the trading range? Maybe here? Looks like it. So let's wait a little bit and see if it respects this as the high. Yes, it does. Okay, so we'll draw a line there. We'll see what happens. And now we have a double top here and here. So we're going to look for a sell signal. And then we got a pretty decent sell signal. So now we have one sell signal near the top and a break of the high of that trading range, and then a second sell signal. So second signal, new high in a trading range. Criteria met. So let's go short here. Let's put our stop loss here. 5 points. And because the range is fairly tight, let's go for R1. So 5 points profit. Immediate fill. We followed the process in integrity with our strategy as defined, and it worked. Context, big up, big down, lots of up and down, trading range. Maybe this is the bottom of the trading range if the trading range started here. First buy signal, second signal after a new low in a trading range. Criteria met. Get long, 2 contracts, and here we can either go for R1 or, because we've got a wedge bottom and we're near the bottom of a trading range and it's on the open, we can also go for a swing. Let's go for R1 In this case, bars are big, so that's 10 points. That puts us right at the moving average. Filled. 1, 2, 3 bars later. That means hold for 15 minutes, make 10 points. Or hold for an hour 30 minutes and make 20 points. The process is not a guarantee, but we execute the process properly, and that's really our only job. When we do, things tend to work more often than not. In this case, we respected the process, and that's what counts. The outcome is icing on the cake, but it's not the cake. We followed the process, and that's how we win. Properly executing the process. Not the outcome, but by properly executing the process. As described. We just as easily could have properly executed the process and lost the trade, and that still would have been a win by our criteria. Likewise, if we win and don't follow the process, that doesn't constitute a win. A win is constituted by properly following the process as described, period.